Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Today I'm pleased that we have Randy Frederick with us. Randy's going to be talking about hedging against currency fluctuations with FX options. Randy Frederick is a Director of Trading and Derivatives at the Schwab Center for Financial Research. And, of course, he's a highly respected industry veteran. And he'll talk about hedging strategies, looking at the dollar relative to other currencies and what the alternatives that you could implement using options. So without further ado, I would like to introduce Randy Frederick. Randy, how are you? Steve Meisinger here.
I'm great, Steve. Thanks so much. I appreciate you having me back.
You're welcome.
All right. Well, I guess we'll go ahead and get started right away. Thanks, everyone, for joining us. What I thought I would do today is talk about some of the strategies that I like, some of my favorite strategies for hedging. So let's go ahead and jump right in. Before we get started, I need to read a disclaimer. Options carry a certain amount of risk. If you're an investor, you know that everything you invest in involves a certain element of risk. And the risk involved in trading options are a little bit different than the types of risks that you encounter when you trade equities. There's a document that's called Characteristics and Risks of Standardized Options that you were probably provided if you've ever had an account approved for options trading at any broker. If you want a copy of this document or if you want to read it, you can click on the hyperlink right there on your screen and you should be able to jump right to it. If you want a hard copy, then you can ask us for a copy at that address that's provided, and we'll be happy to give it to you. Now, any of the examples that I talk about today, and I will be talking about several, I'm going to leave out margin requirements. I might mention them, but they're not included in the calculations. I'm also going to leave out commission charges. Of course, you know commission charges are involved, and they will cause all of your gains to be a little bit smaller and all of your losses to be a little bit larger. But we're going to kind of ignore transaction costs, margin, taxes, all this kind of stuff so we can make the examples a little bit easier to understand. And, of course, as Steve's mentioned, and I'll say it too, I'm using the securities, the symbols that I'm using because they are the FX options products that trade on the ISE. I think they're good examples for the types of strategies I'm going to talk about, but it doesn't mean that I'm necessarily bullish or bearish on any of them or that I'm endorsing or suggesting that you trade any of these specifically. Now, here's a list of the options that are available on the ISE. I believe this is a comprehensive list. If not, I'll let Steve correct me, but I think it's correct. The items, the ones listed above in the big yellow section are all of the ISE currency pairs that are denominated in US dollars. Personally, this is just me. I like to trade the ones denominated in US dollars, and the reason for that is because I'm an American. I think in US dollars. I spend my money in US dollars. Everything to me is denominated in dollars, so I find it much easier to trade pairs that are denominated in US dollars. But there's a contingency of investors out there, and they've been around for a long time, that like to see things in terms of the other currency. So on the bottom in the pink are the four that I think are the only four the ISE currently offers that are available denominated in terms of the other currency relative to the dollar rather than in the dollar. So I've just selected, when I put this deck together a couple of months ago, because I had to run it through compliance and everything, I selected symbols specifically because I thought they had charts that were good examples of the types of strategies that I wanted to talk about today. So again, it doesn't mean I'm specifically bearish or bullish or anything. I just chose the ones that I thought were the best fit given what it was that I wanted to show you. Now, for most American investors, myself included, and probably most if not all of you, when you think about hedging currency exposure, what you're typically talking about, and really the term hedging always really means trying to protect something against a loss in value. So as an American investor, when I think about hedging, what I'm typically talking about is hedging against currency exposure. Usually that means losses that occur when the dollar loses value. And as Steve mentioned, if you logged in a little bit early, the dollar's been getting pounded lately. Now, that's good for the equity markets. As you know, we had an enormous equities rally today, and that was accompanied by a significant decline in the value of the dollar. If you take a look at the dollar versus almost any of these foreign currencies, you'll see charts that show the dollar's just been going down, 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 down. Well, that's partly buoyed the markets, especially since September 1st when we've been in the most recent bull market. But if you have exposure to the U.S. dollar and you're trying to hedge against that, there are some strategies that you can use. I have been trading options for well more than 20 years. I like option strategies. So what I did was I selected four, a couple of simple ones and a couple that aren't quite so simple. So we're going to look at four different option strategies that might help you accomplish this goal of hedging against a dollar decline. Now, looking at where the dollar is now, it would have been nice to have had these a month ago, but that's life, right? Maybe it can still go lower. I don't know. We'll find out. So here are the four strategies I'd like to talk about. The first one is, and they're all bearish strategies because they're strategies that are designed to capitalize on a decline in the underlying asset. And in this case, the ones I'm going to use are the ones that are U.S. dollar denominated. So that means these are all strategies that are designed to profit when the dollar loses value. So first we're going to talk about a bearish put spread, which is a type of debit spread. Then we're going to talk about bearish call spreads, which is also a bearish strategy, but it's a credit spread. And then two that are a little bit more complex, a put ratio spread and a put ratio back spread. Now each of these has specific applications, but they're all intended to be profitable in case the underlying asset, in this case the dollar, loses value. So we'll go through each one of these individually. So hopefully you can see this on screen. I know there's quite a bit of text on there, but what I like to do when I talk about spreads trading or any other kind of strategy is I like to give a couple of examples because I don't want you to assume that if I'm talking about an in-the-money debit put spread, like in the first example, that this is necessarily a moderately bearish strategy or an extremely bearish strategy or whatever. What makes it different is typically just the strike prices that you choose. So what I've done here is I've provided two examples, and on the next slide you'll see them again, where I've used the exact same underlying security, in this case the SFC, which is the Swiss franc. So we're talking about the dollar relative to the Swiss franc. And what I've done is I've chosen two separate spreads, each with the exact same sort of design. They're debit put spreads, but in the first case I've chosen a 108, 105 spread, and the other one's a 106, 103 spread. So they're essentially just using different strikes. What that does is it adjusts my level of bearishness. If I'm just slightly bearish and I'm doing a debit spread, I'll typically want to use options that are already in the money. Because your goal when you do a debit spread of any kind is typically to have both of those options be in the money at the time they expire. Now if you start out with both legs of your spread already in the money, that gives a very high likelihood that they'll still be in the money at expiration. So it doesn't really require a lot of movement. So I can only be just barely bullish, or I'm sorry, just barely bearish, or maybe even neutral, and actually still be profitable in this example. Now on the at-the-money spread, which is the one in yellow, it's the same idea, only this spread is a little more moderately bearish. In other words, it's a little bit more bearish. And the reason it is because I'm using different strikes. I'm starting out with one leg of the spread out of the money and one leg of the spread in the money. Now think about that. If my goal is to have both of them expire in the money, then that means the one that's out of the money actually has to get in the money. And for that to happen, that means the underlying asset has to fall. So being neutral and using the yellow spread strikes, I wouldn't make money potentially. But in the case of the orange spread, if I'm just neutral, I don't really have to be bearish. I just have to be not bullish in order for that to work. So below is just a generic profit and loss chart of what a debit put spread typically looks like. You'll see the white line with the curve in it. That illustrates how the spread profit and loss zones might look at the time you enter the spread. As you approach expiration, the curves get more and more sharp until the point where at expiration they become these straight lines that are illustrated by the borders of the green and the red zone. You can see that the green zone is on the left, which means that as the price goes lower, you make money. The red zone is on the right, which means as the price goes higher, you lose money. And the SPLP stands for short put, long put. So that's where your strike prices are at. So if you fall somewhere between your strike prices, you might make money and you might lose money. If you're below your short put, you're going to be in your max profit zone. And if you're above your long put, you're going to be in your max loss zone. So let's take a look at it on an actual chart of the Swiss franc to see how it looks on the next slide.
Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.